What if you could follow Warren Buffett's personal investing blueprint? A plan so simple, you could write it on a napkin, yet so powerful it could protect and grow your wealth for decades. Buffett says 90% in a single index fund, 10% in a dividend ETF, no stock picking, no market timing, just a disciplined two-part plan. Today, I'll show you why VOO and SCHD fit that bill perfectly and how they work together to create both growth and income you can count on. This video is for educational purposes only and is not financial advice. Past performance does not guarantee future results. Always do your own research before making investment decisions. Most investors overcomplicate their portfolio. They own dozens of ETFs, chase the hottest stocks, or react emotionally when markets swing. The result? Lower returns, higher stress, and an investment plan that's all over the place. Buffett's 90-10 formula is the antidote. 90% in a broad market index fund, 10% in a high-quality dividend ETF. This setup gives you two engines, one for growth, one for income. But for it to work, you have to pick the right ETFs for each role. Without the right growth core, your income won't have a base to build on. Without the right income ETF, your cash flow won't grow faster than inflation. Too often, investors go all in on one side, either 100% growth stocks that pay nothing, or high-yield ETFs that barely grow. That's like trying to drive a car with only one wheel turning. You'll never reach your destination smoothly. Harry used to bounce between strategies. Some years he was 100% in growth ETFs like SCHG, thinking income didn't matter. Other years, he chased high-yield ETFs like DVY, thinking more cash now was better. Neither worked long-term. Growth only meant selling shares in retirement to pay bills. High yield only meant his income couldn't keep pace with rising prices. Then he discovered Buffett's 90-10 approach. 90% in a total S&P 500 ETF for growth. 10% in a dividend growth ETF for cash flow. Simple, scalable, and stress-free. Why VOO is the 90% core? When Buffett says 90% in a simple index fund, he's talking about the S&P 500. That's exactly what VOO does. Here's why it's perfect for the growth engine. Diversification. VOO holds 500 of America's largest, most profitable companies across all sectors. You get exposure to tech giants like Apple and Microsoft, consumer brands like Coca-Cola, and industrial leaders like Caterpillar, all in one ETF. Historical performance. Over the long term, the S&P 500 has returned about 10% annually, despite recessions, wars, and market crashes. That growth compounds massively over decades. Low cost, VOO's expense ratio is just 0.03%, meaning almost all of your money stays invested. Passive and rules-based. No manager guessing what's next. It simply tracks the market, removing emotion from the equation. This is the set-it-and-forget-it foundation that lets the 90-10 plan work. Without a strong growth engine, even the best dividend ETF can't deliver long-term financial independence. Data source. Mentioned, by the way, all the yield, growth, and performance numbers in this video come straight from Seeking Alpha. It's the same tool I use to research every ETF and stock I talk about here. If you want to check it out for yourself, I've put my affiliate link in the description. You can try it free for 7 days and see exactly what I see when I run the numbers. Why SCHD is the 10% complement. If VOO is the growth engine, SCHD is the income booster. SCHD focuses on high-quality U.S. companies with strong financials and a proven track record of paying and raising dividends. The 10% allocation to SCHD gives you a starting yield that's higher than the market average, provides dividend growth to protect your income from inflation, adds a layer of defensive stability in market downturns. And because SCHD's expense ratio is just 0.06%, almost all of your dividend cash flow stays in your pocket. How they work together. VOO compounds your wealth by capturing the market's long-term growth. SCHD generates a growing stream of income that you can reinvest early on and live off later. Together, they balance each other. In years when the market is flat, SCHD's dividends still arrive. In years when SCHD's growth lags, VOO's broad market exposure keeps your total portfolio moving forward. This isn't about chasing the highest yield or the hottest stock. It's about building a machine that runs whether the economy is booming or struggling. Now that you understand how VOO and SCHD complement each other in Buffett's 90-10 plan, the next step is deciding why SCHD is the best choice for that 10% over other dividend ETFs like VYM, DGRO, VIG, HDV, and DVY. Now, we'll break down the numbers: yield, dividend growth, performance, expense ratios, and see why SCHD consistently comes out ahead. In Buffett's 90-10 plan, the 90% VOO core does most of the heavy lifting for growth. But that 10% dividend allocation, that's your income engine. If you choose the wrong ETF, your cash flow could stagnate, shrink during downturns, or fail to keep up with inflation. That's why your dividend ETF needs three things: a strong starting yield to make the income meaningful, consistent dividend growth to outpace inflation, quality companies that can keep paying in good times and bad. SCHD delivers on all three better than its peers. Right now, SCHD's yield is about 3.73%. That's well above the market average and higher than VYM's 2.56%, DGRO's 2.13%, VIG's 1.68%. It's also competitive with HDV at 3.34% and DVY at 3.70%. This means from day one, SCHD puts more cash in your pocket without sacrificing quality. Here's where SCHD really shines. Its 5-year dividend growth rate is 10.87%, the highest among its major competitors. That's more than double VYM's 3.59% and ahead of DGRO 7.62%, VIG 9.60%, HDV 3.43%, and DVY 7.46%. Why does this matter? In dividend investing, growth is the multiplier. If you start with a 3.73% yield and grow payouts at 10% a year, your income can double in about 7 years without adding a single extra dollar. Over 20 years, that's potentially a 4-fold increase in annual income, even if the yield never changes. Contrast that with an ETF growing payouts at just 3% a year, your income would barely keep pace with inflation, and your purchasing power would erode. SCHD has raised its dividend every year for 13 straight years. That's on par with VYM, 14 years, and well ahead of DGRO, 10 years, and VIG, 11 years. HDV and DVY have much shorter streaks, just 3 and 4 years. This track record means SCHD has navigated market corrections, sector downturns, and economic slowdowns without cutting its payout exactly what you want from an income engine. Over the past 10 years, SCHD's share price is up 113.39%, beating VYM 102.84%, and DVY 80.57%, while DGRO 152.77% and VIG 163.37% have higher price gains. They've done so with much lower yields, meaning their total income over time is smaller. Over 5 years, SCHD is up 43.34%, ahead of HDV 41.91%, and very competitive with higher growth peers when you account for its yield advantage. This balance of price appreciation and income growth is exactly why it works so well alongside VOO. SCHD's expense ratio is just 0.06%, matching VYM and VIG, and lower than DGRO, 0.08%, and DVY, 0.38%. Every fraction of a percent saved in fees is money that keeps compounding for you instead of a fund manager. Once a year, SCHD rebalances its holdings. Companies are screened for return on equity, dividend history, and financial health. Weak performers get replaced by stronger ones. This keeps the portfolio full of financially sound businesses, while funds like VYM or HDV may keep underperformers longer due to looser criteria. Think of VOO as your growth foundation, 500 of America's best companies, driving your wealth upward over decades. Think of SCHD as your income accelerator, paying you now and growing those payments year after year. In bull markets, VOO powers up your net worth. In flat or down markets, SCHD's dividends keep your plan moving forward. It's the balance that makes the 90-10 strategy work. Fast forward 15 years. Your VOO shares have multiplied in value. Your SCHD dividends have doubled, then doubled again. Instead of worrying about the next market dip, you're cashing checks every quarter, confident that both your portfolio and your income are built to last. Buffett's 90-10 strategy works because it's simple, cost-effective, and time-tested. And when it comes to that 10% dividend slot, SCHD's blend of yield, growth, consistency, and quality makes it the standout choice over VYM, DGRO, VIG, HDV, and DVY. If this helped you see why VOO and SCHD make such a powerful long-term team, tap like so I know to make more breakdowns like this, and subscribe so you don't miss the next strategy that could change your financial future.